IRS has published its annual inflation adjustments for more than 60 tax provisions for the 2026 year. What does that mean for you and your family?
Joining us for Insights is Lawrence Sprung. He's the founder of Midland Financial, and he's also the author of Financial Planning Made Personal.
Lawrence, good to have you with us this morning.
Yeah, good to be here.
Let's start with the main changes that people should know about.
Yeah, so I think that the things that people need to be aware of is starting in 2026, we've seen adjustments in the standard deduction. We've seen the income brackets broaden out, and we've seen the highest tax bracket stay the same as at 37%. So I think the important thing for people to know and understand is be aware of what the brackets are, what the standard deductions are for 2026, and start planning now. Don't wait till December 2026 to start planning this, or even April 2027 when you're looking to file your returns. Get started now and have some plan in place for that.
And with those changes, maybe you can go a level deeper on what's new, especially as it relates to credits and benefits.
Yeah, so I think one of the biggest changes that's going to affect people, and this was not an IRS thing, this was a Secure Act 2.0 thing. This is a big change for people. People who are over the age of 50 who are contributing and maxing out their 401ks, if they earned over $150,000 in 2025, their catch-up provision, because there are two components to the 401k contribution, the employee deferral, and then if you're over 50, the catch-up. If you're over that 150 in 2025, that catch-up's gonna have to go into a Roth component, not the traditional. That's one of the biggest changes that a lot of people don't realize is taking place as of January 1 that I really think they need to be aware of.
And what's that implication of having to devote it to a Roth versus other, portfolio opportunities?
Yeah, so that $8,000 that would be the catch-up provision can't go in pre-tax, it has to go in post-tax. So it's a way for the government to get more tax revenue. But in essence, I would say this, it's not a bad thing because we're seeing a lot of families who are putting away money pre-tax very heavily, and then when they end up in retirement, all the money that they're pulling out is taxable. So by forcing them to put in after-tax money that's going to grow and be tax-free in retirement, it's really setting them up, I think, to be in a better position too.
And let's dig in a little deeper on the changes to the thresholds for middle-income earners to start with.
Yeah, so what's happening is, and without going into every bracket, really it's just expanded those numbers in a way that they've raised up those limits. So essentially, at the end of the day, those middle income earners, if their situation stays the same, they should be at the same or if not less taxable income in 2026. So it's really setting them up in a way because the IRS is increasing those brackets because of inflation and the hope that people's incomes are also increasing as well.
And so we're kind of going into a funny position here because most people are not thinking about 2027, they're thinking about what they have to do right now to sort their 2025 filings. But what should they prepare for the following year? What pitfalls might they encounter that if they just have an ounce of prevention now, it's going to make their life easier on the back end?
Yeah, I think taxes end up being something that people just do in the rearview mirror, right? So like we're talking about 2025 now. Yeah. Come January, people are going to start getting their documents together and looking backwards as to what happened. And then their accountant or CPA is going to say, hey, this is what you owe or this is what you're getting back. And it's very reactive, based upon what happened. So what we're trying to do is just educate people and say, hey, we know it's not 2026 yet. These changes are coming into place. Don't think of this the same way that you thought about it all along. Go into it with a game plan. And what I would also suggest is don't wait the whole year to check it again, right? If you put a game plan together now for 2026, maybe in June or July when you're halfway through the year, take a look and see where you line up with those brackets. Are there things that you might be missing out on? Should you be thinking about standard deduction versus itemizing? Are there opportunities for you to lower your tax base? Think about that proactively instead of just letting the tax situation happen to you over time.
Yeah, and to that point, people oftentimes forget that they're spending out of pocket for things, but that can actually reduce their taxable income. So they need a strategy for that, right?
Yeah, I think one of the things, you look at like FSAs and HSAs. HSA is probably one of the most underutilized tools
for
available.
Health spending.
Yeah.
You're buying whatever you buy at the pharmacy, you're not even thinking about it.
And it's triple tax free because you're putting it in tax deferred. it's growing tax-free, and then you're taking it out and not paying any taxes on it either. So it's a huge benefit, and we all need Advil, Tylenol, contacts, Band-Aids, even just those staples are HSA eligible items that you could be using those tax-free monies to be paying for.
Okay, so for people who might be thinking about selling stocks or rental property next year, will these changes impact them?
Yeah, so what you have to look at is you want to, capital gains, which is what you're talking about, selling assets like that, you want to look at, those are preferential treatment in terms of taxes. So you're not paying at ordinary income rates. You're paying anywhere between 0 to 20%. And where you are in that range is really dependent upon what your income is for the year. So there may be ways for you to reduce your income and reduce your capital gains exposure. And then during the year, you want to look for opportunities if there are dips in the market, like in 2025 during Liberation Day, we saw a dip in the market. That could have been an opportunity for people to sell stocks at a loss or sell assets at a loss, maybe even rebuy them 30, 31 days later and take that loss and use it against some of their gains this year. So you have to be a little bit more strategic. Don't just wait to look at your assets in December and see what your gains are and what your losses are. It's something that should be constantly looked at throughout the year.
It's interesting because you're a financial planner helping people grow their wealth. And then the accountants say, what works in our office is the opposite of what works in the wealth advisor's office. So because of course you want to minimize your income as much as possible when claiming what should be taxable. So what kind of strategies do you generally have for people to sort of balance what is kind of a strange irony in that regard?
Yeah, so we work hand in hand with families and their accountants because most of the things that we're advising families on have some sort of tax implication, right? Whenever you're looking at monies and dollars, there's tax implications. So we're working very closely with them to ensure that we're on the same page. So there are certain things like this time of year, we've had some families that have had some significant gains throughout the year. So we're looking again for opportunities to take losses that we might be able to achieve and lower their tax liability. But it is important that, and I think you bring up a good point, that your accountant shouldn't be over here and your financial advisor over here and they never talk or interact. They should be a cohesive unit and working in your best interests, and that's something we coordinate each and every day for the families we work with.
In that strategy you're talking about taking losses, it's basically like, do you want the government to decide what to do with your disposable income, or are there things that are near and dear to your heart, since the money's going somewhere one way or the other? So
yeah, I mean, listen, there are rules set out, right? And you want to operate within the rules. You pay whatever taxes you owe at the end of the day, but there are rules in place that allow you to have a little control over your taxable income during the year. If you just sit and ride it out, you're not going to be able to take advantage of any of those opportunities. So you want to be proactive, plan accordingly, and make sure that you're taking advantage of all those opportunities that may be afforded to you over time.
And so with that in mind, just as the end of the year wraps up, do you have any advice for people out there who are looking at what they can do to really shore up where they're at right now and make the most of things before the end of this month?
Yeah, so I mean, they have a couple of weeks left that they might be able to make some changes. So look at your retirement account. If you have not put in enough this year for whatever reason and think you could boost up your contributions this year and start taking advantage of that. Worst case, use the little bit of downtime that we have during the holidays and use it as an opportunity to say, hey, you know what, 2025 is going to be the last year that I'm going to just be along for the ride, and 2026 is going to be a year where I'm going to start proactively planning. And if that's something you can do on your own, great, do it on your own. If you can't, look for a financial fiduciary advisor that can help you and assist you in putting that game plan together so you're maximizing and taking advantage of all these things we're discussing today.
Always great advice. Lawrence Sprung from Midland Financial, thanks for joining us.
Thank you.